This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only.
Okay, good day everyone. Welcome back. Good day, Deanna.
Hey Shane.
How you doing?
I'm good.
I think you were just reminding me of a comment by Lennon that there are decades when nothing happens and then there's weeks where it seems like a decade happens.
Sure feels like that this year.
Yeah, it certainly feels that way. Every week we seem to have one thing after another. We had DeepSeek one week and then tariffs from Trump, and we're still getting that. And we've now got the RBA back again.
And the election.
And the election's about to be called, or could soon be called. As people listen to this, it might even have been called, who knows. But let's just start off with Australia. We had a 2.5 month between RBA meetings, 2.5 month break between RBA meetings, which, to be honest with you, I was quite happy with because I was getting sick of hearing them. And now they're back. And, of course, we got that momentous decision to cut interest rates after 13 hikes. Mm-hmm. So what did you make of that?
Well, they're back with a vengeance. They released their statement on monetary policy too on the same day, which updated their forecasts. I mean, basically what I took from that whole release from them was that their forecasts justified the need for a rate cut. If you look at their numbers, their assumptions for the trimmed mean, which is Australia's version of core inflation, and now assumes that the trimmed mean will be at 2.7% over the year by around the middle of this year. And that's basically a year sooner than what they were expecting previously. So around the middle of that 2 to 3% target band. All the other forecasts were mostly unchanged. They did actually revise down their unemployment rate forecast a little bit, and their wages forecast was higher, which I think looked a little bit strange to me. Growth still looks pretty subpar, around 2% on average in the next 1 to 2 years. So I think it would have been hard for them not to cut if they had those inflation numbers in there, given that we've seen basically every other major central bank cut on inflation data that's in line with ours right now.
But you would have thought, given all of that the RBA would be sort of happy with a rate cut and happy signalling that there might be more cuts. But the actual impression that came from the RBA was, some would say, somewhat hawkish.
It was a hawkish cut for sure.
Yeah, one commentator in one of the newspapers said something like, that they did it out of pity rather than economics, which I thought was a little bit over the top. But there is that sentiment around that maybe they didn't really want to cut, or they don't think they're going to be cutting again.
Well, some commentators have said that the pile-on by economists and the media some media, I guess, not all media wanted a rate cut, but some media to cut interest rates, and from economists that drove financial market pricing over 90% price for a rate cut at the February meeting that could have led them to the decision to cut interest rates. But I don't think that was necessarily the case. I just think that they told us that monetary policy is still restrictive. It's just less restrictive than it was a month ago, which I think is a good way to think about it, because we have seen a 4.25% increase to interest rates. And just by taking 25 basis points away from that, I mean, we still have the cash rate at 4.1%. So it's still a restrictive level of interest rates to the economy. So it's not like one rate cut is really going to make a huge difference to consumer spending. I mean, on our calculation, someone with an average mortgage is probably going to save an additional $80 $80 a month from the rate cut. That's not that significant in the scheme of things.
Yeah, I mean, given that that same borrower is now paying, well, would have been paying up until now, something like 12, 13, 14,000 extra in interest payments on their mortgage, given the rate hikes over the last few years. It's just a reverse one fraction of that impost. The thing that interested me, though, was the RBA seems to be constantly concerned the labour market is too tight, that's going to cause some sort of surge in wages costs, leading to inflation remaining way too high. And then, of course, we get to today, the day we're recording this, and we get more data showing that wages growth is actually slowing down. So why would you even worry about the tight labour market if wages growth is slowing down? To me, the only reason you'd worry about a tight labour market is if it's causing excessive wages growth and keeping inflation above target. But all I can see is wages growth slowing down.
Yeah, I think the RBA's misread the wages story. I mean, they're going to have to revise down their wages growth forecast. I suppose their thinking has been the data for the December quarter, which we got today, showed annual wages growth at 3.2%, private sector up by about 0.7% over the quarter, public sector a bit lower, about 0.6%. But they're anticipating that a lot of the public sector, or some of the public sector agreements, particularly for healthcare workers, were a bit delayed in the December quarter, and they may actually come through in the first 6 months of 2025, which is why they've got wages growth going back up to 3.4%.
But the private sector numbers were still soft. Apparently it was
they were very soft, yeah.
There was the lowest proportion of private sector workers in any December quarter getting a wage rise since 2019. And it was the lowest quarterly rise in the private sector, which wasn't distorted by these things since 2022. So it looks to me like momentum is well and truly down in terms of wages growth, and that's the only reason we'd worry about a tight labour market, but things are going the other way.
I think it's also the private sector that basically drives the momentum or shows you the momentum in the labour market, because it's the one that has the largest share of people on individual agreements, so people who are job switching, and that gives you an indication of actually how tight the labour market is. I mean, I get the sense that the Reserve Bank isn't super confident about its own estimates of labour demand and supply, and they sort of alluded to that in the statement on monetary policy, that they're not sure if their previous estimates that labour demand was still running above supply were actually right. I mean, our view is that the non-accelerating inflationary rate of unemployment, otherwise known as NAIRU by economists, is actually somewhere below 4%, and the Reserve Bank still thinks that it's a bit higher than that. I think they're going to have to revise that down. But where do you see? I mean, the Reserve Bank sounded like they are definitely not going to cut in April. Maybe they don't want to get involved with the election, which hasn't been called yet, but it may occur in April. Will we get another rate cut in the next few months, or what do we need to see to actually see the Reserve Bank cutting interest rates? Because it didn't really seem to me like they were that confident that more rate cuts were needed.
Well, I reckon the RBA is being overly cautious. I thought coming into this meeting we'd get a cut, but it would be a cautious cut in the event the RBA's caution was probably a little bit more than I would have thought. I reckon to see another cut, you just need to see more evidence that inflation is slowing down, that the labour market is not causing a wages breakout, and that demand growth in the economy, even though it might be picking up a little bit, is still pretty subdued. And I reckon by the time we get to March, there'll be enough evidence to suggest that those things are happening, and therefore we'll get another cut. April is like putting the election aside, because the April meeting, which incidentally is on April Fool's Day, which could lead to all sorts of jokes, I'm sure, on that day, but it could be in the midst of an election campaign or just prior to one being called. So it seems, given RBA's current guidance, they wouldn't have been cutting then in April anyway, whether there's an election or not. But by the time we get to May, we get another round of quarterly inflation numbers, and I think they will come in below RBA expectations. Apparently, if you back out the number from their charts, you get a trim mean estimate for the March quarter at 0.8%. That's their forecast. We'll probably see a bit of a pick-up from the 0.5% we got in the December quarter, but I reckon it'll be a little bit less, only to 0.6 or something like that. If that's the case, then I think it would probably clear the way for another cut in May. And then I think we'll get another one in August. Basically, we're looking at a growth picture which is a little bit weaker than the Reserve Bank has been forecasting. And I think at some point over the next 6 months, the RBA will end up revising down its NAIRU from 4.5% to around 4% or thereabouts. I mean, it's this concept of navigating by the stars. Central banks look at these stars, one being the potential output level for the economy, so they try and assess actual output or GDP relative to that. Then there's R star, which is the neutral rate of interest rates. On the RBA's estimates, they've got 4 or 5 or 6 of those. They've got in a graph. They're all like spaghetti going all over the place.
It was between like 1.5% to 4% or something.
Yeah, there's a range there. But the central tendency is below where we are at present, which is 4.35% for the cash rate. And then you've got the NAIRU, which some might call U star or something like that. So central banks try and navigate by these things, but they're all a bit dodgy. They're all a bit unclear as to where they are precisely. And even though Governor Bullock was quite cautious the other day, I reckon her tune will change a little bit by the time we get to the next meeting. And that's not being critical. I mean, my tune changes as well as you get new data. I think it's just a situation where we'll be able to see more cuts, just as other central banks are still cutting, whether it's New Zealand, Canada, Europe. It's worth noting that our core rate of inflation or underlying inflation, the trim mean, is not that different to what you're seeing in Europe or Canada, both of which now have rates well below our rates. So I reckon we are on track for more cuts. Only thing to note is that even if we get 3 cuts this year, there was 13 hikes, interest rates will not be back at zero on the cash rate anytime soon, and probably won't get there for many, many years if they do at all. And mortgage rates will still be way above where they were before. So that's still going to act as a bit of a constraint on spending in the economy, and therefore it's not time for people to break out the champagne by any means. And there's still that issue that price levels, when you go to the shops, as you mentioned on the last podcast 2 weeks back, prices over the last 4 years are up 19%, wages are up 14%. People are still behind.
And so when we think about other global central banks, they're still cutting rates. Is there a chance that maybe with some of the tariffs that have been announced on potentially on Canada and Mexico, even the steel and aluminium on Australia in the last few weeks, does this change central banks' profile for inflation? Are the tariffs going to add to consumer prices?
Well, they could do, but it's mainly, I mean, there's a long-term issue that if global trade shrinks and the world becomes less competitive, that imparts upwards pressure on prices, much like the opening up of the world after the Berlin Wall came down in the late 80s and China entered the global trading system. That led to downwards pressure on inflation, so now you could start to see the reverse. But that's a longer-term effect.
Yeah.
I think the short-term effect is if Trump keeps putting tariffs on, tariff man Trump keeps putting the tariffs on, then it's more of a threat to US inflation than other countries. But if the other countries retaliate and put tariffs on as well, then that does impart some upwards pressure on their inflation. But it's unclear that they're all going to be doing that. Maybe they will, maybe they won't. It's hard to know which way this will go. But ultimately, if you do have a tariff war between countries, then that means less economic activity globally, or a trade war, less economic activity globally, and that can put downwards pressure on inflation. So it's all a bit messy. The US, I guess, is at the centre of it, and that's why the Fed is a bit more cautious on interest rates, whereas other countries still seem to be signalling more cuts ahead, even though they all admit to the uncertainty. And when it comes to Australia, I reckon it's quite clear that the tariffs and the threat of tariffs, potential tariffs on steel going to the US and aluminium, the US is reportedly considering an exemption, but we don't know how that's going to turn out. We've got tariffs potentially on pharmaceuticals. Trump's talking about a 25% tariff on cars, pharmaceuticals and semiconductors that he might formally announce in April. That will also hit us. Pharmaceutical exports to the US are more than double the value of our steel and aluminium exports. So we can get a hit there. But when you add it all up, it's only about 0.1% of GDP. So it wouldn't be a monumental disaster. The real danger would come if you get this global trade war coming through, which obviously creates some consternation in markets. Interesting thing so far, I reckon, is just how resilient share markets have been through all of this. You saw a bit of that in 2018, and eventually it built up.
Yeah.
It was too much, and then share markets came down significantly between September and Christmas Eve 2018. But so far it's been resilient, which unfortunately may embolden Trump to do more.
Well, it's probably just a factor of a lot of the tariffs haven't actually gone through yet because, apart from China, the Canadian and Mexican ones haven't started, and the other ones that he's threatening are still in negotiation. So if they actually do start on the 1st of April, I think that share markets will respond with some more downside. Yeah, because they will. And also, I guess maybe share markets thinking, well, we survived this in 2018, we can survive it again. And the US economy is in a stronger position than it was in 2018, I'd say, and the global economy is probably a bit too. We're still getting some rate cuts, whereas back then we were getting some rate hikes, and earnings growth is still holding up. So there are still a lot of positive things that are happening in the US economy and in the global economy that will keep share markets buoyant.
It seems like April 1 is the key date. The RBA in Australia is a meeting. And then in the US, it's the due date for their trade policy reviews, after which they might announce more tariffs. I also kind of wonder whether you worry about these things. We go to work and you worry about all these sorts of things. And then I go home at night and see all the the funny stuff coming out of the US, like the order to rescind the requirement to buy paper straws.
Because they explode.
Because they explode. Has anyone actually had a paper straw that explodes? Or the other issues, the banning of an Associated Press reporter from White House press conferences for lying about the true name of the Gulf of Mexico. And I'm going to Google Maps and looking at other things. Yeah, it's still called the Gulf of Mexico. What's the problem? Well, apparently in the US they've changed it. But these things maybe give people laughs. And so they think...
At least it's good for our content and for econocides.
They're good for econocides and good for comedians. I mean, these days comedians don't even have to try. You just run the clips out of the US and you've got your funny stuff there. Well, they do. I shouldn't say that. But anyway, it is an interesting world we've come into.
That's it for this week. Thank you, Shane. Talk to you next time.
Thanks, Deanna.
For more info on Shane and Deanna's podcasts and reports, head to the Insights Hub at amp.com.au.